Welcome back, everyone, for another deep dive.
Yeah.
This time, we're going to be taking a look at a pretty well-known book in the investing world.
Yeah, a classic.
Yeah.
It's William O'Neill's How to Make Money in Stocks.
Now, this one, a lot of our listeners have probably heard of this book
Right.
and maybe even read it.
Mm-hmm.
But I got to say, this is one that you pick it up and it's pretty dense.
It can be intimidating.
Yeah.
Yeah, there's a lot there.
Yeah. So today's deep dive is, I think, is going to be really valuable because, we're going to really distill it down to, what are those nuggets that we can take away and actually apply.
Exactly. Yeah, hopefully make it a little less daunting for people who haven't tackled it.
Right, right. So what for you was like the biggest kind of, I don't know, concept or takeaway from the book?
Well, obviously you can't talk about this book without talking about the Can Slim framework,
Right.
which is really the kind of the core of his whole stock picking strategy. And it's all about identifying companies that are, poised for explosive growth, not just value picks.
Okay.
And he really leans on this framework that he developed from studying years and years of winning stocks.
Yeah, and one thing that I thought was really interesting is like he's not afraid of those high price to earnings ratios. They kind of
Right.
a lot of investors, it kind of scares them off. You know what I mean?
Yeah, totally.
He seems to embrace them.
Absolutely. He kind of challenges that whole buy low, sell high thing.
Right.
He's arguing that a lot of those seemingly expensive stocks can actually be the biggest winners, especially if they have, the right ingredients for growth.
Okay, so let's break down this CAN SLIM acronym because it's clearly kind of the core of this whole strategy.
Yeah.
So what is C?
So C is for current quarterly earnings per share. And O'Neill's really big on this. Like, he wants to see significant year-over-year growth, ideally 25 to 50%, or even more. He points to examples of companies with earnings shooting up 100, 500%.
Wow.
That's not just a little nudge upwards. It's a sign of real momentum.
Yeah, he's not talking about any earnings report, right?
Yeah.
He's specifically talking about focusing on that earnings per share number and comparing it to the same quarter a year earlier.
Exactly. Why is that? Well, because, as individual investors, earnings per share are what really impacts your return. That's the bottom line. And comparing to the same quarter eliminates any seasonal distortions that can sometimes make a company look better than it actually is.
Okay, that makes sense.
So he's all about cutting through the noise and getting to the real story.
Right, yeah. So C, strong earnings. What about A?
So A is for annual earnings increases. And he wants to see, again, consistent growth over several years. So at least 3 years of solid earnings increases to show that this isn't just a one-hit wonder.
Okay.
This company's got staying power.
So it's about identifying companies that can kind of keep delivering.
Keep it up, yeah.
Impressive results year after year.
Exactly. And that's another place where he really pushes back on that, fixation on low price to earnings ratios.
Right.
Because, a low PE, it might make a company look cheap.
Right.
But it could also signal that, growth is weak.
Mm-hmm.
And he's not interested in that.
Yeah, he points to some pretty, I guess, well-known companies like Xerox and Syntex and Genentech that had these seemingly high PE ratios before making these huge jumps in price. So it's like there were hidden gems that a lot of people were overlooking.
Exactly. He's looking for that bigger picture of, potential for growth, companies that are disrupting industries, innovating, capturing market share. Those are the companies that, can justify those higher PE ratios and potentially deliver those big returns.
Okay, that makes a lot of sense. So we've got C for strong current earnings, A for those annual earnings that are consistently increasing.
Right.
What about N?
So N stands for new, and O'Neill's really drawn to companies with, fresh ideas, innovative products, new management, or stocks hitting new highs.
Okay.
It's all about that, catching that wave of momentum early on.
So it's not just about the numbers. It's about the story behind the company, right?
Exactly.
Like, are they shaking things up? Are they...
Are they launching a new product?
Yeah. Are they on the cutting edge?
New CEO.
Right.
New market.
Right.
All those things, yeah.
Okay, so N for new.
Yeah.
What about...
So S is for supply and demand. And on the supply side, he wants to see, a reasonable number of shares outstanding because too many shares can, dilute ownership and make it harder for the stock price to really take off.
Okay.
And then just as importantly, he wants to see strong volume demand.
So looking for those signs of institutional interest,
Mm-hmm.
those big investors putting their money where their mouth is.
Exactly. He wants to see the big players buying in, but he also warns against stocks that are overowned, where everyone's already piled in and the biggest gains might already be over.
Right, so you don't want to be too late to the party.
Exactly. You got to find that sweet spot.
Okay, so we've got strong earnings, annual growth, innovative companies, the balance of supply and demand. What about L?
L stands for leader or laggard, and O'Neill's, he's adamant about focusing on the stocks that are outperforming their peers.
Okay.
The leaders.
So not just doing well in a vacuum, but they have to be kind of crushing the competition.
Exactly. Yeah, he even compares it to buying art. The very best pieces usually cost more.
Right. They're in high demand.
Exactly.
Okay, so L for leader. What about I?
So I is for institutional sponsorship. And he's not saying you should just, blindly follow the big institutions.
Right.
But he does think it's wise to pay attention to which funds are buying a stock.
Okay.
And whether the number of institutional owners is increasing.
So it's kind of seeing where the experts are placing their bets.
Exactly. But again, he warns about overowned stocks.
Right. So it's got to be that balance between following the smart money without getting caught up in the herd.
That's right.
Okay. Last letter.
Yeah.
M. What's that for?
M is for market direction.
Okay.
And O'Neill is a firm believer in not fighting the overall market trend.
Right.
You don't want to be buying stocks in a bear market.
So even the best stock can get swept up in a broader downturn.
Absolutely. You need to be aware of those conditions and, adjust your strategy accordingly.
Okay, so Can Slim, so it's kind of like a multifaceted lens for looking at stocks to kind of help you find those companies with, that explosive growth potential. But he doesn't stop there.
Right. No. He's also a big advocate for using charts.
Oh, yeah. Charts are a big deal for him.
Yeah.
Oh.
He believes that charts provide, valuable insights into a stock's price history.
Right.
Can help you identify those potential buying opportunities. He talks about, key chart patterns like the cup with handle and the double bottom.
Okay.
Which can indicate that, a stock is setting up for a significant move.
So it's about more than just the current price. It's understanding the history, how the price has behaved over time.
Exactly, yeah.
What kind of details should we be looking for when we look at these charts?
Well, he really emphasizes the importance of waiting for a stock to, break out of a base pattern on high volume before buying. So it means, the stock has to surge past a previous high point with a significant increase in trading volume.
Okay.
Which really shows, strong conviction from buyers.
So it's not just the pattern itself, it's about that volume.
Exactly.
To confirm it.
Yeah, you could see a stock forming a promising pattern, but if it breaks out on low volume, it could be a false signal.
Okay.
He's all about those high volume breakouts.
So looking for those extra layers of confirmation.
Exactly.
No.
Yeah. And on the flip side, he warns against buying stocks that are making new lows, that could signal underlying problems, lack of interest from buyers.
So you want to be buying strength,
Yeah.
not weakness.
It's like that old saying, don't try to catch a falling knife.
Right.
You want to be on the uptrend.
Yeah, for sure. So charts, big part of his toolkit, but he also looks at those factors beyond the earnings, beyond the chart patterns, right?
Yeah, he mentions new products
For strong management.
which we kind of talked about with the in Can Slim. But what are some of the other things he looks for?
Well, one interesting one is he likes to see companies buying back their own stock.
Okay.
Because he views that as a positive sign.
Right.
Showing that they believe their stock is undervalued.
Okay.
And they have confidence in future growth. They're putting their money where their mouth is.
So it's like a vote of confidence from the company.
Yeah, exactly.
Okay.
He also emphasizes relative price strength, which ties back to the L for leader. Stocks that are already outperforming the market tend to continue doing so.
So it's about finding those stocks that are already on the move, those that are already kind of showing that, that strength and resilience.
Exactly.
Okay.
And that's something we'll be talking about more the next part.
Okay, so it sounds like O'Neill's really building a case for going against a lot of the conventional wisdom about finding bargains.
Yeah. And focusing on companies that are already kind of demonstrating, that winning potential.
Yeah, he's all about shifting your perspective and looking for those signs of strength and growth.
So it's about changing how you think about a stock.
Absolutely. He wants you to find those future leaders.
Okay, so we've covered the CAN SLIM framework, the charts, some of those additional factors, but he doesn't just analyze stocks in isolation, right?
No, he doesn't. He also talks a lot about industry group analysis.
Okay.
He's a firm believer that, stocks don't move in isolation.
Right.
They tend to move in groups based on, broader trends, industry innovations, consumer demand.
Right.
So you've got to be aware of, the sector that you're investing in as well.
Okay.
And understand the dynamics there.
So it's like a rising tide lifts all boats.
Yeah, exactly. He encourages investors to focus on, stocks in leading industries because those are the ones that have, the strongest tailwinds. He actually created, his own system for tracking 197 different industry groups.
Wow, 197. That's a lot.
Yeah, and he ranks them by performance.
Okay.
So you can see which ones are leading the charge.
So you're not just looking for a great company.
Right.
You're looking for a great company in a great industry.
That's exactly it.
It's like a double layer of confirmation.
Yes, confirmation, exactly.
Okay. That's really interesting. And I guess the other thing that jumped out at me from that section was how, the leaders in one bull market don't necessarily repeat in the next one. So you can't just kind of rely on same old winners.
Yeah.
Right?
Yeah.
It's about being able to adapt and stay ahead of the curve.
That's right.
So we've covered a lot of ground here. That CAN SLIM framework, the power of charts, this idea of industry group analysis. We've touched on some of those additional factors that he considers. But it's clear he's built this really comprehensive system for kind of, analyzing stocks, identifying those with, that explosive growth potential.
He's really trying to find those big winners.
Right.
Yeah.
But he's also very clear about managing risk and having a disciplined approach to selling.
Absolutely.
Which we're going to dive into in the next part of our deep dive.
Sounds good. One of the things that really struck me about O'Neill's approach is how he doesn't just talk about numbers and charts. He really gets into the psychology of investing, which I think is so important for anyone trying to navigate the market.
Right, because it's one thing to, understand like the mechanics of a system like CAN SLIM, but it's another thing entirely to, actually have the discipline and the mindset to apply it in the real world, when you're actually putting money on the line.
Absolutely. And he doesn't sugarcoat it. He talks about how our natural instincts often lead us to make decisions that actually hurt our portfolios.
Right.
We get scared when the market drops.
Right.
We get greedy when it's going up.
We hold on to those losers too long.
Yeah, hoping they'll come back.
Yeah.
And we sell winners too early.
Right.
Because we're afraid of losing our gains.
Like we're working against ourselves.
Exactly. He actually tells this great story about a turkey trap to illustrate this point.
Okay.
So there's this young boy who's watching this old man catch wild turkeys using this trap.
Okay.
And the trap is baited with corn, so a few turkeys wander in.
Okay.
And the old man, he shuts the door, even though there are still more turkeys outside.
Right.
And the boy, he asks, why don't you wait for more to enter?
Right.
And the old man replies, because if I wait too long, the turkeys inside will get scared and fly away. I'd rather have a few in the bag than none at all.
I see where he's going with that. You don't have to catch every single opportunity.
Exactly.
It's about recognizing when you have a profit and taking it.
Yeah, and that's why he's so big on, cutting losses quickly, limiting your losses to, 7 or 8% to protect your capital.
So how does that actually play out? Like, when do you actually sell?
Right. Well, he has a whole chapter dedicated to sell rules.
Okay.
And he covers, everything from weak price action, declining volume, stocks making new highs on low volume, stocks forming third or fourth stage bases.
Can you break down what that means for someone who might not be familiar?
Yeah, so he talks about how, stocks tend to move in cycles, right, forming these bases before they launch into, new rallies.
Okay.
So a first stage base is, that initial consolidation after a stock has made a big move.
Right.
As the stock continues to climb, it might form additional bases.
Okay.
And each one is kind of like a potential launching pad for another upward move.
Yeah.
But, as a stock progresses through these stages, the potential gains, they might get smaller.
Okay.
And the risk of a reversal might increase. So a third or fourth stage base, that might be a sign that the stock is kind of, getting tired.
Right.
And that the easy money has already been made.
Okay, so it's like the later stages of a marathon.
Right.
Those runners are getting tired.
Yeah.
It's harder to keep up the pace.
Yeah, and O'Neill's all about recognizing, when a stock is topping and getting out before the real damage is done.
Okay.
Like, don't fall in love with your stocks.
Right.
Be willing to let them go when they start showing signs of weakness.
So how does that selling discipline tie back into that market psychology?
Well, cutting losses short goes against our natural instincts, right?
Right.
We don't like to admit we were wrong.
We hold on to those losers.
Right. We're emotionally attached.
Yeah.
And we hold on hoping they'll come back.
Yeah.
Even when, the evidence suggests that they're not going to.
Yeah, we remember the price we paid.
Right.
And we don't want to sell it for less. Yeah.
But O'Neill's saying you need to detach yourself from those emotions.
Go back.
Focus on the facts. If the stock is breaking down, if it's triggering those sell signals, get out.
Yeah.
Even if it hurts.
So being proactive, protecting your capital.
Exactly.
Okay.
And he even encourages investors to embrace short selling in certain situations.
Okay, so that's a little more
Yeah.
advanced.
It is a bit more advanced.
So for those who might not be familiar, what does it actually mean to sell short?
Essentially, it's betting against a stock.
Okay.
So you borrow shares from someone else, you sell them at the current market price,
Okay.
and then you hope to buy them back later at a lower price when you return those borrowed shares.
So you're profiting from a stock going down
Exactly.
instead of up.
That's right. But he does make it clear that this is risky
Right.
and should only be done by experienced traders who, understand what they're doing.
So not something to just jump into lightly.
Definitely not, yeah.
Now, I know, O'Neill's all about finding those big winners
Right.
and letting them run, but he also recognizes that not everybody's cut out to be a stock picker.
Yeah, absolutely.
Right.
He talks about mutual funds as another option.
Okay.
He's got a whole chapter dedicated to them, explaining how, they can be a great way to participate in the market's growth without, having to pick individual stocks.
So it's about, diversifying your portfolio, potentially reducing your risk.
Exactly.
Without having to become, a stock market guru.
Yeah, exactly.
Yeah.
He talks about, the importance of picking the right type of fund, aligning it with, your risk tolerance and your investment goals.
Okay.
And he stresses the importance of long-term thinking when it comes to mutual funds.
So don't jump in and out.
Yeah, he actually advises against that.
Okay.
He says the big money is made by staying invested through multiple market cycles, riding out those inevitable ups and downs.
Right. So not trying to time the market.
No, not at all. He's actually a big advocate for dollar cost averaging,
Okay.
which is a strategy of, investing a fixed amount of money at regular intervals,
Yeah.
regardless of, what the market's doing.
So it takes the emotion out of it.
Right.
You're consistently investing over time.
Yep. Knowing that, the market's going to go up, it's going to go down.
Right.
But over the long term, it tends to go up.
That's the hope.
That's the idea. Be patient. Be disciplined.
Okay.
Don't try to time the market.
Hey.
Don't chase those, short-term gains.
Now, you also had some interesting thoughts on how to measure and select those money managers,
Yeah.
especially those who are, handling those larger institutional portfolios.
Yeah, he's actually very critical of the way that many institutions evaluate their managers.
Okay.
They focus too much on, short-term performance.
Yeah.
And he argues that managers should be given at least a full market cycle, typically 3 to 4 years,
Okay.
before their performance is really judged.
So they got to go through a bull and a bear.
Exactly. Give them a chance to show their skills through different market conditions.
Okay.
He also criticizes some of the ways that, institutional investors approach portfolio management.
Okay.
He argues that many institutions are too focused on large cap companies,
Right.
those big established businesses.
Right.
And they rely too much on, traditional valuation metrics like price to earnings ratios.
They might be missing out on those
Exactly.
smaller growth opportunities.
He's a big advocate for looking beyond those usual suspects and, considering a wider range of, investments. He even offers advice for those interested in exploring, things like exchange-traded funds, real estate, foreign stocks.
So he's really encouraging investors to kind of think outside that that traditional box.
Yeah, take control of your investments. Don't be afraid to, challenge the conventional wisdom.
Okay, that's really interesting. Now, we talked about the psychology, earlier. He also, dedicates a whole chapter to kind of debunking some of these, common mistakes that investors make.
Right.
Like averaging down instead of up, buying those tips and rumors.
Yeah, or neglecting to learn how to use charts.
Right.
Big mistake.
Over diversifying. So he's not just providing a system, he's also kind of,
Yeah, he's trying to address those behavioral biases that can often lead us astray.
Yeah, and he even shares like some personal anecdotes about, his own early investing blunders. So
Yeah.
it makes it kind of relatable, even someone as successful as him.
Exactly. It reminds you that, investing is a journey.
Yeah.
It's not like an overnight success story. He didn't just, wake up one day and suddenly become a stock-picking wizard.
Right. Yeah, it's a process.
Exactly.
You got to, learn.
He had to learn from his mistakes.
Refine your approach.
Exactly.
And he also challenges this idea that investing is all about being right all the time.
Right.
He actually emphasizes the importance of, cutting losses, limiting your downside, letting your winners run.
Right. Maximize the upside.
So it's not about winning every single trade. It's about managing your risk.
Exactly.
Effectively.
Yep. And letting those big winners, outweigh those losers.
He even points out that successful investors can be wrong, like a significant percentage of the time.
Yeah, they're not always right.
But they still end up ahead.
That's right.
Because they're managing that risk.
Oh, that's the key.
That's a good point.
Yeah, takes a lot of the pressure off.
Yeah.
You don't have to be right every time.
No, that's a comforting thought, I guess.
It is.
To know that, you're going to be wrong sometimes.
It's going to happen, yeah. But you can still be successful.
And as long as you manage your risk and kind of, have that long-term perspective.
Exactly. He actually uses a sports analogy. He compares successful investing to, a football team that consistently makes small gains and avoids those big plays.
Right.
It's a slow and steady approach that wins championships, not the, flashy all-or-nothing plays.
Right. Consistency and discipline.
Exactly. Like anything in life, right?
Yeah, anything worth doing. Yeah.
Yeah.
So he really emphasizes, having a plan, sticking to it, even when the market's, getting a little choppy.
Yeah, that's when it's hardest.
Right, when your emotions are telling you to do something different.
Exactly. But you gotta stay the course.
Right. Yeah, that mental fortitude.
It's key, especially when, things aren't going your way.
Yeah, it's so easy to get caught up in that fear and greed of the market,
Absolutely. But O'Neill encourages investors to, stay grounded in their research, their system.
Their long-term goals.
Their goals, exactly.
He even has this list of 21 costly mistakes that investors make.
He does, yeah.
And, he really encourages readers to kind of examine their own behavior.
Yeah.
Are they making those same mistakes?
Exactly. He wants you to identify those patterns that might be, holding you back.
Right.
It's not just a book you read and put on a shelf.
Yeah.
It's something you actively use.
So be your own coach.
Exactly.
Constantly evaluating.
Yeah.
Okay.
He wants you to treat investing as a business, approach it with that same level of discipline and detail as you would any other endeavor.
So not just a hobby.
No, this is serious business.
Right, this is your hard-earned money.
Right. And he also talks about the importance of, studying successful companies, studying other successful investors, learning from their strategies, identifying the patterns that have led to, consistent success.
So it's like studying the greats.
Exactly.
In any field, you can learn a lot from those who've achieved that high level of success.
Absolutely. And he's not just, talking about these things in a vacuum. He connects those historical trends to current market conditions.
Okay.
So he's trying to help investors see the bigger picture, anticipate those potential shifts. He's not providing, a static set of rules. It's all about ongoing learning and adaptation.
So it's about always learning, always adapting as the market changes.
Exactly.
And, he also is very vocal about his belief in the power of individual investors. He really wants to, democratize access to information.
Yeah, he wants to empower people.
Right, and empower people to take control of their, their financial futures.
And he's actually pretty critical of some of the practices of Wall Street firms. And analysts, he argues that, they often prioritize their own interests over those of their clients.
So he's a bit of a maverick.
Yeah, he's not afraid.
Challenging the establishment.
Call out bad behavior, challenge the status quo. That's right.
Now, one thing that really, I guess, sets O'Neill apart from a lot of these, investing writers is this, deep understanding he has of how the market actually works.
Yeah.
It's not just theoretical advice.
Yeah.
He's got, the data.
He does. He built one of the first computerized stock market databases
Wow.
in the U.S., tracking decades of market history to identify those patterns, those recurring patterns that lead to big wins.
So he's not just relying on intuition or gut feeling. He's actually got the data to support his claims.
And he's always testing, always refining his strategies, looking for those edges that can help investors achieve, those superior returns.
So he's almost like a, scientist in a way, constantly experimenting.
Yeah, looking for those patterns.
Looking for those repeatable patterns. Yeah, that's fascinating.
Yeah.
And he's been recognized, right?
Oh yeah, he's been recognized by some of the top institutions for his work.
Right.
He's spoken at conferences. He's shared his insights with some of the most influential investors in the world.
Okay.
But he doesn't just talk to the elite.
Right.
He's written these books.
Right.
Created Investors Business Daily to make his knowledge accessible to everyone.
So he's really?
Yeah, he's committed to empowering individual investors.
Okay.
Regardless of their background or their level of experience.
Okay, great. Now, one thing that we haven't talked about too much, but he really emphasizes, is the importance of industry group analysis.
Right, and we touched on it a bit earlier.
Yeah.
With the L for leader in CanSlim.
Yeah, but I'm curious to hear more about, his system for tracking these groups and identifying those that are showing, the most potential.
So he points out that, stocks don't move in isolation, right?
Right.
They tend to move in groups based on broader trends, industry innovations, consumer demand. He actually created his own system for tracking, 197 different industry groups.
197?
Yeah, it's a lot.
Wow.
And he ranks them based on performance, so you can see which ones are, leading and which ones are lagging.
So you can see where the action is.
Exactly. And you can't just rely on those same old winners.
Right.
The leaders in one bull market often don't repeat in the next.
So you're constantly having to adapt.
Yeah, it's a constantly evolving puzzle,
Right.
which makes things interesting.
So how do you actually go about identifying these leading groups?
Right. Well, he uses a combination of factors: price performance, earnings growth,
Okay.
relative strength. He also looks at the overall health of the industry, things like innovation, consolidation,
Okay.
deregulation.
So it's not just about chasing those hot stocks. It's
Yeah.
about understanding the fundamentals of the industry.
The dynamics there,
Okay.
and the potential for future growth. He also talks about something he calls the washover effect,
Okay.
where, even within a strong industry group, there are certain stocks that are going to significantly outperform the others.
So it's like a
Yeah.
a double layer.
You got to find those standouts.
Right. You find the gold mine.
Exactly. He even suggests looking for, what he calls cousin stocks.
Okay.
So suppliers or related companies that benefit from the success of a particular industry leader.
So it's almost like that ripple effect.
Exactly.
Yeah.
Yeah, the success of one company can create opportunities for others.
Yeah. And he also talks about staying up to date
Right, you got to stay
on
informed.
industry news and trends.
Yeah, you can't just sit back and,
Right. So be an active participant.
be an active participant. Exactly. Always looking for those signals that indicate a potential shift or a new growth cycle. And he's got some interesting thoughts about how to use the news media effectively as an investor.
Okay. So how do you
Right.
actually do that?
He cautions against, blindly accepting everything you hear or read.
Right.
Be a critical thinker.
Yeah.
Consider multiple perspectives.
Right.
Don't just take everything at face value.
Right. So
He even provides examples of, how the media can sometimes be misleading or biased.
okay.
Often focusing on sensationalism or promoting narratives that don't always align with reality.
So we got to develop our own filters to kind of...
You got to be able to discern the signal from the noise,
Right.
and focus on sources that, provide accurate and reliable information.
So be an informed consumer of information.
Exactly. Not just, a passive recipient. He even talks about, understanding the spin that companies and analysts might put on information.
Okay.
He wants you to look beyond those headlines, dig into the data.
So it's about being skeptical, but open-minded, right?
Yeah, that's a good way to put it.
Okay.
He even provides some tips on how to, spot those red flags in company reports.
Okay. Like what?
Like unusual accounting practices.
Okay.
Overly optimistic projections.
Right. So...
Yeah, he wants you to question those assumptions.
Right. Don't just take everything at face value.
And, he also talks about understanding the broader economic and political landscape.
Okay.
Because those factors, they can have a huge impact on the market.
So it's about seeing the forest for the trees.
Exactly.
Okay.
He encourages investors to stay informed about things like interest rates, inflation, government policies, global events.
So it's about understanding the big picture.
Right.
Those forces that are driving the market.
He even provides examples of how, historical events have shaped those market cycles. Okay.
Things like the Great Depression.
Right.
World War II, the dot-com bubble.
So history repeats itself. In a way, it does.
Now, one thing that really sets O'Neill apart is his emphasis on this personal development.
Yeah, it's not just about stocks and charts.
Right.
He really delves into those psychological, emotional aspects.
Right. We talked about the turkey trap.
Exactly.
And
Yeah.
the importance of selling discipline.
He wants you to understand your own biases and your tendencies.
Right. So it's like he provides these tips on how to develop the discipline, the patience.
The mental toughness.
Yeah, to actually succeed in the market.
Yeah, he's a big believer in the power of mindset, arguing that, your beliefs, your attitudes can have a huge impact on your investment results.
So you got to have the right, mental framework.
Exactly, yeah.
To actually apply, that system.
He wants you to cultivate a growth mindset.
Okay.
Be open to new ideas. Embrace learning as a lifelong process.
Okay.
And take ownership of your decisions, good or bad.
So no excuses.
No excuses.
Okay.
Learn from those mistakes.
Yeah, take responsibility.
Exactly.
Yeah.
And he provides examples, even some of the most successful investors in history.
Right.
They face setbacks, failures along the way.
Yeah. Everybody makes mistakes.
Exactly.
But they kept going.
Yeah, they persevered. They stuck with it.
And he also emphasizes that, anybody can learn to be a successful investor if they're willing to put in the work.
Exactly. Yeah.
So it's about, putting in that time, the effort.
Develop those skills.
Develop those skills, yeah.
He even talks about the importance of, surrounding yourself with the right people.
Okay.
Those who support your goal.
So build a supportive network.
Yeah, find a mentor, join a community.
Yeah, find those people.
He's a big believer in the power of community and mentorship.
Yeah, it's easier when you've got, others to learn from.
Exactly.
And to kind of keep you accountable.
And that's what he's tried to create
with
Investors Business Daily, his books, the workshops, seminars, all that.
Yeah. So it's really...
He's passionate about helping people achieve financial freedom.
Yeah.
Reach their full potential.
It's really inspiring to see someone who's, not just successful in the market, but also, committed to
sharing his knowledge
and really empowering others.
Absolutely. Yeah.
Now, I know he's a, big believer in, free markets, but he doesn't shy away from talking about the role of government and regulation in the market.
He's a strong advocate for policies that, promote economic growth and encourage entrepreneurship.
Okay.
He believes that, a healthy, vibrant market, it benefits everyone, not just the wealthy elite. But he can be, critical of excessive regulation, bureaucratic red tape that stifles innovation and hinders progress.
Right. So it's about finding that balance.
Exactly.
Between protecting investors and consumers without, stifling that growth.
That's the key.
Okay.
And he even gives examples, how government policies have influenced market cycles on past.
So it's fascinating how he kind of ties that historical perspective into, what's happening today.
He's always connecting those dots.
Okay, so we've covered a lot of ground.
Yeah, we have.
Market psychology, industry analysis, the role of government and regulation. It's clear he takes this really holistic approach
Yeah.
to investing.
He doesn't just focus on, one or two things.
Yeah.
He tries to consider everything.
Okay, so he's not just a stock picker. He's
Yeah,
a student of the market.
exactly.
And he encourages investors to
To be the same.
be the same.
Yeah.
Yeah, and one of his signature tools is his emphasis on these charts
Right.
and technical analysis.
Yeah, that's a big part of his, his toolkit, host, speaker. We talked about some of those basic patterns earlier.
Right.
But I'm curious to hear more about his approach to this whole idea of,
Yeah.
technical analysis and how he uses it to actually, spot those buying and selling opportunities.
So he's a big believer that the market tells the story,
Right.
that the price and the volume
Yeah.
of a stock can kind of give us insights into whether it's strong or weak.
Exactly. Yeah. He's developed this whole system of chart patterns, indicators that can
That's
help
it.
investors identify, those potential opportunities, both buying and selling.
So what are some of the the key things that he looks for in those charts?
Well, we talked about those patterns earlier, like the cup with handle, the double bottom.
Right.
And he really stresses, waiting for a stock to break out of a base pattern on high volume
Okay.
before buying, even if it means missing, that absolute lowest price.
Okay.
He's all about buying when the odds are in your favor, not just chasing cheap prices.
Right.
He even cautions against, buying stocks that are making new lows because that could signal problems.
Right.
Underlying problems. He uses these charts to, help him time his entries and his exits,
Yep.
aiming to buy when a stock is showing, strength momentum and to sell when it's starting to,
Right.
show some weakness.
Right.
He's really good at reading those subtle cues that the market is sending.
So it's not just about the pattern itself. It's about understanding the context.
Exactly, yeah.
Yeah.
The overall trend.
And he even teaches investors how to use these charts to manage risk, right?
Yeah.
To identify those key levels.
Yeah, those levels of support and resistance.
Right. So you're not just trying to predict
No.
where it's going, but also kind of protecting yourself.
Right, exactly. He's all about, managing risk,
Yeah.
preserving capital.
Yeah, it's not just about making money.
It's also about not losing money.
Right.
It's both sides of the coin.
Yeah. So he's not just a technical analyst. He's also
Right.
a risk manager.
Exactly, yeah. He also uses charts to, understand the overall market trend,
Okay.
identifying those key turning points, potential shifts in sentiment.
Okay.
He's a big believer in following the market's lead,
Right.
not trying to predict it
Yeah.
or outsmart it.
Don't fight the market.
Yeah, he's often quoted as saying, let the market tell you what to do, don't tell the market what to do.
Right. That's
Words to live by.
yeah, that's a good quote. So it's about humility, I guess. Recognizing that
You can't always be right.
right. Markets.
The market's going to do what it's going to do.
Yeah.
And you have to react to it.
So it's about being adaptable,
Yeah.
flexible,
Yeah, don't be too rigid.
right, recognizing that things change.
Yeah, you need to change with them.
And that, one thing O'Neill really emphasizes is the role of psychology
Right.
in investing. And we touched on it earlier.
Yeah. Yeah, the turkey trap.
Right.
Right.
He's a keen observer of human behavior.
Yeah.
He understands how our emotions can really lead us to make our, bad decisions.
Yeah, irrational decisions. That can
Yeah.
hurt us in the long run. He even has that chapter in his book
Right.
where he kind of debunks some of those common mistakes that investors make.
Yeah, like buying on tips and rumors.
Yeah, chasing
Chasing hot stocks, failing to cut losses.
Right.
Those are classic mistakes.
Yeah, so he's not just a market expert.
Right.
He's also a bit of a
psychologist. So what are some of the practical tips he offers for overcoming those emotional hurdles?
well, he talks about the importance of having a plan,
Okay.
sticking to it.
Okay.
Set those clear rules for yourself,
Well-
both for buying and selling. and write those rules down.
Okay.
So you're less likely to deviate from them when things get, a little heated.
So remove the emotion.
Exactly,
Sorry.
yeah. He even talks about, developing a thick skin in the market. You got to be able to handle those setbacks, the losses,
Right.
without letting them derail your long-term plan.
Right. Stay the course.
Yeah, mental toughness.
So it's really about having that discipline.
Yeah.
The mental fortitude to kind of stay calm and rational when things get
Especially when things get crazy.
right, when things get a little crazy.
Because it's easy to panic and make those emotional decisions.
Right, right. Now, one thing that I thought was interesting about O'Neill's approach is this focus on the power of momentum.
Yeah, he's a big believer in identifying those stocks that are already on the move.
Right.
Those that are showing that strong upward price trend, increasing volume.
So he's not necessarily looking for those undervalued stocks
Right.
that everyone else has kind of overlooked.
Yeah, he's definitely not advocating for buying stocks that are, falling in price or that are stuck in a downtrend.
Okay.
He really believes that, stocks that are already showing strength and momentum are more likely to continue moving higher.
Right.
And he uses this principle to, really kind of identify those potential winners.
So it's about finding those stocks that are
Yeah.
already breaking out.
Yeah, those that are showing signs of strong demand, upward momentum.
Right. He even uses that phrase, buy high and sell higher,
He does, yeah. It's
which kind of goes against a lot of the traditional
yeah.
thinking about buying low,
Mm-hmm.
right? Selling high.
Mm-hmm. But he argues that, trying to catch those falling knives, those stocks that are dropping in price,
Right.
it's often a recipe for disaster.
And it's tempting to want to buy those stocks that seem cheap.
It is, yeah. But
But he's saying you're often better off buying those that are already showing that strength and momentum.
he even encourages investors to look for those pocket pivots.
He does.
Literally.
Little shifts in price and volume that can signal that, a stock is starting to regain momentum
Okay.
after a pullback.
So it's about being able to kind of spot those early signs.
Yeah, get on board before the big move takes off.
Right. So you're not just blindly chasing
No, not about
those
it.
stocks that have gone up to most.
You got to understand the context.
Yeah.
Look for those signs of strength and momentum.
Right.
Identify those stocks that are, poised to keep moving higher. Now, one thing that O'Neill is very clear about is that his approach
Yeah.
is not without risk.
Right. No investment strategy is foolproof.
Right. There's
Yeah.
always potential for lie.
He acknowledges that the market is inherently volatile. There are no guarantees.
Right.
But he does believe that by following his system, managing risk effectively, and having that long-term perspective,
Right.
investors can increase their chances.
Yeah. Yeah. So what are some of the key things he kind of talks about for managing that risk?
Well, he's a big believer in setting stop-loss orders,
Okay.
which are, orders to sell a stock if it drops below a certain price.
So you limit your potential losses.
Exactly.
Yeah.
He also, talks about the importance of diversifying your portfolio.
Right. Don't put all your eggs in one basket.
Yeah, spread your risk
Right. Right.
across different stocks,
Oh, okay.
different industries.
Okay. And he also stresses that long-term perspective, right?
Yeah, absolutely.
Being able to ride out those,
Those downturns.
the ups and downs.
Exactly. He's a big believer in time in the market.
Okay.
It's those investors who are able to stay the course that ultimately, achieve the greatest success.
So don't panic when the market drops.
Right.
Just
He
it's-
even encourages investors to view market corrections as opportunities
right.
to buy high quality stocks at a discount.
So buy when others are fearful, I guess, is
Yeah.
the lesson there.
That's the idea.
Okay.
Be greedy when others are fearful.
Okay. Now, one thing that's I think really inspiring about O'Neill
Mm-hmm.
is his his passion for teaching
Yeah. He's very committed to that.
and empowering others. Right.
Yeah, he's dedicated his life to sharing his knowledge,
Right.
helping others achieve financial freedom.
Yeah, and he's got the books. He's got Investors Business Daily.
He even started a nonprofit
Yeah.
dedicated to teaching financial literacy to young people.
So it's really I guess impressive to see someone who's achieved that level of success.
Yeah.
But is also just so committed to kind of
Giving back, paying it forward.
Yeah, giving back.
He really believes in the power of education, making investing accessible
Right.
to everyone, no matter, their background.
So it's not, just for the, the wealthy elite.
No, not at all.
Right.
Anybody can do this.
Anybody can do this, yeah.
If they're willing to put in the work.
Okay, great.
Yeah.
So I think that's about all the time we have for today.
Yeah, we've covered a lot of ground.
Yeah, we really dove deep into William O'Neill's investing philosophy.
We did, yeah.
Explored the CAN-SLIM framework, the charts, the technical analysis.
All the psychological insights.
Yeah, the psychology of it.
Yeah.
His belief in the power of
the individual investor.
Right, the individual investor to really take control and succeed in the market.
That's right.
So whether you're a seasoned investor or just starting out, I think there's always something to be learned from O'Neill's work.
He really challenges us to, think differently, be more disciplined.
Right.
And never stop, striving for excellence.
Right. So keep learning, keep exploring, and we'll be back soon with another deep dive.
We will, yeah.
Into the world of investing.
Until then, happy investing.